Hey everyone, welcome to today's Explainer. We're jumping right in to break down one of the absolute most popular vehicles in the investment world right now, Flexi Cap funds. More specifically, we're popping the hood on the massive HDFC Flexi Cap mutual fund. We really want to understand exactly how it functions, how it handles those inevitable market bumps, and whether it actually deserves a spot in your portfolio. So, here's our roadmap for this Explainer. We're going to cover 1, what a Flexi Cap is, 2, the HDFC Flexi Cap's performance history, 3, comparing its peers and returns, 4, volatility and portfolio shifts, 5, decoding key risk metrics, and finally, a beginner's long-term growth guide. All right, let's kick things off with Section 1. What exactly is a Flexi Cap? Simply put, a Flexi Cap mutual fund is an open-ended equity fund. But the really cool part is that it gives the fund manager total freedom. I mean, they can shift your money across companies of literally any size, large, mid, or small, without being tied down by those rigid, predetermined category constraints that you see in other funds. Think of it kind of like driving a car with a manual transmission. If you invest in a strictly large cap or mid cap fund, the manager is basically forced to stay in that lane, even if those specific stocks get way overvalued or hit a massive downturn. But with a Flexi Cap, the manager can actively shift gears depending on the market terrain. If small caps are looking just way too risky, they can just shift the weight right back into stable large caps. It's a huge advantage because it builds structural flexibility right into your portfolio. Let's move on to Section 2, HDFC Flexi Cap's performance history. We're going to look at a specific massive engine in this category to see how this plays out in the real world. This is one of the absolute largest active Flexi Cap funds in India. We're talking over 1 lakh crore rupees in assets under management. To put that number into perspective, that's roughly the GDP of some small countries. It launched way back in 1995, and it boasts a really impressive 18.3% annualized return since inception. That is some serious scale and a very, very long track record of wealth creation. And this really illustrates its speed historically. When you contrast it directly against its benchmark, the S&P 500, the longer-term picture is pretty striking. While the one-year return hovers around a, modest 2.5%, the fund has historically delivered around 18.1% over a 3-year horizon and nearly 17.8% over 5 years. It consistently outpaces that broader market benchmark when you actually give it enough runway. Which brings us to Section 3, comparing peers and returns. How does it objectively stack up against other vehicles on the same track? Let's anchor to the data here. When you stack it up against heavyweights like Purag, Kotak, and Aditya Birla Flexi Cap, you'll see it competes in a super tight race. Over a 5-year span, HDFC's roughly 17% compound annual growth rate is incredibly competitive, putting it right in the top tier of its category. So it really proves that its massive size hasn't slowed it down at all compared to its direct peers. All right, Section 4, volatility and portfolio shifts. Let's see how this track record holds up to recent events, because navigating current volatility is what actually matters today. And recently, this massive fund got a brand new driver. In February 2026, Amit Ganatra took the wheel from the previous manager, Roshi Jain. Now, whenever a fund this large changes hands, investors totally panic about how the new manager is going to handle market volatility. But looking at the data from his first 4 months, we saw some distinct and honestly fascinating shifts. The new manager shifted gears fast. First, he took the fund's massive cash holdings, which were sitting at around 13.2%, and aggressively deployed them down to 4.9%. And to balance that aggressive move, he tilted the portfolio heavily into large cap stability, pushing it all the way up to 76.7%. He also selectively doubled the mid-cap allocation. But here is the crucial part. The core foundational holdings, heavyweights like ICICI, HDFC, Axis, and SBI, they remained completely intact. It was a calculated adjustment, not some massive disruption. Now, what's really interesting here is how this engine is heavily powered by financial services. I mean, it makes up almost half the portfolio. This shows a very strong conviction from the management team in the resilience and growth of the banking sector. They're basically using it as a heavy anchor to absorb market shocks, all while looking for growth over in consumer cyclicals and healthcare. Okay, moving right along to Section 5, decoding key risk metrics. This is especially important for conservative investors. I know financial metrics can be incredibly dry and honestly intimidating. We hear these Greek letters thrown around all the time, but we need to answer the real question, what is the actual impact of these numbers on your hard-earned money during a market crash? Let's start with beta. You can essentially think of beta as the shock absorbers on your car. It gauges the bumpiness of the ride relative to the overall market. So the key takeaway here is that the HDFC Flexi Cap Fund has a beta of 0.82. Because this number is less than 1, it means this fund historically experiences fewer violent swings than the broader market. For conservative investors worried about downside risk, a beta of 0.82 suggests this fund should theoretically cushion the blow during a market crash, dropping a bit less than the index itself. Then we've got alpha and standard deviation. Alpha is basically the manager's secret sauce. It measures the excess return the manager is generating above what the market just gives you for free. HDFC FlexiCap has historically maintained a highly positive alpha, which tells us the manager is actively adding real value. Then standard deviation, which is sitting around 12 to 13%, tells us the expected range of portfolio swings. Notably, this 13% is actually lower than the category average of 15.6%, which points to a relatively smoother ride for you. And hey, you don't just have to take the fund house's word for it. Independent academic studies, like this peer-reviewed paper from JETIR, rigorously analyze these exact figures. The study reinforces that the fund's risk-adjusted metrics consistently provide greater returns compared to the risk-free rate, making it a highly efficient vehicle for wealth generation over time. And finally, Section 6, Beginner's Long-Term Growth Guide. With all this data on performance, manager shifts, and risk metrics, how do beginners actually use this to assess and build long-term capital growth? Here's your actionable roadmap. First, remember this is not a get-rich-quick scheme. Adopt a holding horizon of at least 5 to 10 years to really let compounding do its thing. Second, set up a disciplined monthly SIP, a systematic investment plan, to automate your entries and buy more units when the market is cheap. Third, ignore the short-term noise. That includes temporary market dips or the kind of manager transitions we just talked about. And finally, rely on the core advantage of the FlexiCap category. Let the manager shift the gears so you don't have to. Because, as researchers rightly point out, the real danger to your wealth usually isn't market volatility, it's bad behavior. It's that massive temptation to stop your SIPs when the news gets scary or selling your holdings at a loss during a decline. The FlexiCap structure is literally designed to handle the market risks. You just have to manage your own behavioral risks. So, to wrap up this explainer, I want to leave you with a question to ask yourself. Knowing that markets are inevitably going to rise and fall, are you ready to simplify your portfolio? Are you willing to let a flexible, active manager handle the asset allocation and the volatility while you focus entirely on your long-term goals? Thanks so much for joining me on this deep dive, and keep learning.